Let me show you how it is more expensive to rent than to buy your home. To show you though, I need to first tell you about the three major benefits that get overlooked or few people talk about as homeowners. First is the mortgage interest deduction and the property tax deduction. Now these are significant deductions because they allow you to deduct the interest that you paid on your mortgage and the property taxes that you paid for each year. When you have a mortgage, a significant portion of your monthly payment goes towards paying interest and property taxes. Now, the IRS allows you to deduct the interest paid on your mortgage as well as the property taxes paid, which means that a portion of that expense is effectively subtracted from your taxable income. This is how it works in very simplified terms. Assuming that you earn $100,000 and your tax bracket is 20% and you do not own a home. Well, you're going to have to pay the IRS about $20,000 in taxes for the year. Now, let's assume that you own a home and we're going to use the same income, $100,000, and the same tax bracket, 20%. However, now you own a home and you paid $30,000 in mortgage interest and property taxes for the year. Now, this $30,000 reduces your total gross income in the eyes of the IRS, of course, down to $70,000. Now you pay taxes on the $70,000 at 20%, which is $14,000. This is about a $6,000 difference per year. And that's all because you own a home. And if we divide that by 12, that's about $500 a month. There are limits, of course. The IRS allows you to deduct interest on loans up to $750,000 for most homeowners, or up to $1 million if you're married and filing jointly. You may also deduct moving expenses, energy efficient home upgrades, and mortgage point expenses, which can add up and are usually one-time expenses and not reoccurring, like mortgage interest and property taxes. By taking advantage of these deductions, you reduce your taxable income, which means that you're taxed on a lower amount. This leads to a significant tax savings, potentially resulting in a lower tax bill or even a higher tax refund. Who doesn't like that? It is important to note that everybody's tax situation is unique and different, and the amount of tax savings will vary depending on factors like your income, deductions, and specific rules and limits set by the IRS. Consulting a tax professional or using tax software can help you maximize your deductions and determine your actual tax savings. So to summarize, when you buy a home and utilize these IRS allowed deductions, you're essentially leveraging the tax code to your advantage. You're reducing your overall tax liability, and you're keeping more money in your pocket. And during our Zoom presentation, I will show you what these numbers look like for your purchase scenario. The second benefit of homeownership is equity built from paying down your principal balance on your mortgage. You see, when you take out a mortgage, you borrow a certain amount. This initial amount is what we call mortgage principal. Each month, part of your payment goes towards reducing the principal amount, and part of it goes towards paying the interest that was accrued on your loan. Over time, as you continue to make payments, the principal amount decreases. And as you pay down, you build equity, and the equity is the difference between the current value of your home and the amount you still owe on your mortgage. So basically, as you pay down your principal, your equity increases. It's like filling up a savings jar every month. Over time, you're effectively transforming your debt into a valuable asset. This is money that you can tap into later through a home equity line of credit, a cash out refinance, or the sale of the home. Now, let's compare this with renting. When you rent, your monthly payments go to the landlord. Unlike a mortgage, these payments do not contribute to any homeownership or equity. It's like filling up someone else's savings jar. This is why some people feel that they're throwing away their money when they're renting. Your hard-earned cash does not build an asset for you. It builds it for your landlord. And number 3, home appreciation. Home appreciation is the term used to describe the increase in a home's value over time. This can be due to many reasons, such as improvements to the home. Say you remodel the kitchen, well, that's going to help with the home appreciation. Also, a growing demand in the housing market overall, or a lot of economic growth in the area. Say there's a lot of jobs that are coming to that area. Well, people need a place to live, and that drives the prices of rent and the prices of homes up. And home appreciation is sort of like a savings account that grows as the value of your home grows. But it is not that simple. You see, in the past few years, we've seen dramatic spikes in home prices. And this is due to a unique combination of low interest rates, low inventory, and high demand. This spike in home prices can be very exciting, but it is not typical. So let's not get used to it. So this brings me to why it's crucial to consider a historical average when forecasting future home appreciation. That way you can plan ahead. Now, the 63-year historical average gives us a more realistic picture of how home values have increased over a longer period, factoring in periods of both growth and decline. By using this average, we could kind of calm the expectations and make more informed decisions. Remember, your home is not just a place to live. It's also an investment. And by understanding home appreciation and using historical averages, you can ensure that your investment is going to be a wise one. So now that you have a basic understanding of these benefits, let's go over a rent versus own scenario and put it all together. I promise that this illustration is going to be mind-blowing. And if you don't fully understand all these benefits that we just discussed, it's okay. We'll go over them during our Zoom call. For now, let's jump into this rent versus own. Now, here we have a mortgage comparison with 3 different scenarios. You can see that option 1 is a $700,000 purchase with 0 down. Payment is $5,139, and this includes the principal, interest, tax, and insurance, and any other monthly expenses associated, like HOA or mortgage insurance. And right below this payment, in green, is the IRS tax benefit that I have calculated. Remember, from just a few minutes ago, the IRS allows you to deduct the mortgage interest and property taxes, and this saves you thousands in taxes at the end of the year. So I took those savings, divided them by 12 to show you what it looks like per month. And moving down to the next box in orange is the principal pay down amount per month. Out of the total $5,139, $732 per month goes to paying down your loan. And just like I mentioned a few minutes ago, when you are renting a house, you are paying your landlord's loan down and basically throwing away your money. So after considering these 2 benefits of home ownership, your net monthly payment is actually a lot lower. It's $3,537. Now, let's talk about the third benefit, which is appreciation. Assuming that you buy this home at $700,000 with an annual appreciation rate of 6.6%, which is a conservative 63-year average for Santa Clara County, in 5 years, this home you buy today will be worth at least $931,000. By then, the principal balance will be at $641,383 because remember, you are paying down your loan every month. And let's just say you want to sell this home at this point. Well, it would cost you about $65,000. So after paying your existing loan off and all the closing costs to sell, your gain or profit on this sale would be $224,446. Now, let's just say you decided not to buy or you get priced out for whatever reason you do not buy. The rents paid during this same 5-year period, assuming that you're paying $3,500 a month and assuming that there are no rent increases along the way, which is not likely because we know that rents are going up, but let's just play it safe. That total would be a whopping $210,000. And at the end of this 5-year period, you will have nothing to show for it. Now, let's back up a little bit. Do you see the difference between the gain of $224,000 versus the loss of $210,000? That's huge. That's a big difference. And I hope this illustration helps you see the true cost of renting. And more importantly, I hope it makes you a little bit angry because this is only a 5-year forecast, which is short term. Imagine what this looks like at 10, 15 or 30 years. I mean, this is generational wealth type of money, and you may be missing out on this. Again, this is not rocket science, what I'm doing here. It's just math, and I'm here to assist you in figuring it all out. Thanks for watching, and I'm looking forward to our Zoom call to review your mortgage comparison tailored to your specific scenarios.